You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIW Tweets.
Hello, welcome to The Investor Way with me, Sam Ball, and my co-host, John McEwen. In this week's episode, we're going to be talking about ITV, Burberry, Persimmon, Taylor Wimpey, Direct Line and Disney. And then we'll also have a discussion at the end just about general market conditions this week following Pfizer's announcement that they have a vaccine. So John, shall we start with ITV?
Yeah, so ITV, what have they come out with this week, Sam?
So ITV have come out with their third quarter trading update. They said external revenues fell 16% to 1.9 billion, which included a 13% fall in broadcast advertising revenue to 1.3 billion and a 19% drop in studio revenue to 902 million. So 85% of their productions had been halted because of coronavirus, but most of them are now back up and running or have been finished. And they said that they're actually expecting the total advertising for Q4 to be slightly up year on year, providing the lockdown ends when it's meant to, which obviously isn't a guarantee.
It's not a guarantee.
But just to go into a bit more detail. So the total advertising revenue fall of 16%. So the online revenue increased 2%. However, it wasn't enough to offset the declines elsewhere. And advertising, they've said that total advertising spend was down 1% in October, having sequentially improved since a 23% drop in July. They noted that a few sectors are actually spending more on advertising compared to last year, including supermarkets, publishing and broadcasting, telecoms, food, government charities, and household stores. And they said that the total viewing actually increased 2%. Reduced soap opera and lack of Summer Love Island meant that online viewing fell 6%. Monthly active users rose 1%, and their share of the viewing was down 4%. From 23.2% to 22.2%. And they've put that down to a higher volume of news content on BBC. They've said they're on track to deliver the previously announced cost savings of 60 million in 2020, and 10 million of that will be permanent and repeated every year. Net debt was 775 million at the end of September compared to 783 million at the end of June. And in total, they've got liquidity of 1.2 billion, which is made up of 400 million of readily available cash and 829 million of credit. Overall, I'd probably say it could have been worse.
Yeah, it could have been worse. And I think the shares were down about 1% on the day. So I think it probably could have been much worse. And of course, they had over the summer the Euros being cancelled as well. I imagine that was probably a big hit to ITV as well.
One thing that is quite interesting is within the next 2 years now, they've got Euros, Olympics, and a World Cup.
So that's very positive, assuming that these things are able to go ahead. And we'll come on to the Pfizer vaccine news later. But assuming they all go ahead, that's a big boon for ITV.
Revenue was always going to be down. There's nothing they can really do about that, especially with the amount of it that comes from sectors such as travel. But a 16% drop, it's not too bad. And then the fact that viewership is actually up slightly, I think advertising revenue is going to bounce back when we get some sort of normality. So providing the viewership's the same, I think they've got a good chance of bouncing back to previous levels.
Yeah. And I suppose it would depend on how much some of the companies are willing to pay for the advertising as well. And the sort of changing landscape, because now you have more advertising digitally, not just sort of on online television, but on social media as well.
Yeah. So in terms of the valuation, they're now trading at a PE ratio of 9 compared to a 10-year average of 11.6. And the prospective dividend yield in the next 12 months is 5.7%.
Yeah. So, I mean, I suppose it sounds fairly attractive. I guess it's quite a cyclical business. Do you like it?
I own it. I bought it a couple of months ago. Currently got a market cap of 3.72 billion.
Mhm.
In terms of the share price, it's at about 92p, and that's compared to a 52-week high of 165p and a 52-week low of about 50p. So
Okay.
I bought it, I think high 60s, probably around there. And I think at the time, although that PE of 9 is fairly reasonable, I think the PE, it was under 6 at one point.
Yeah.
And that was, I think, about where I bought it, possibly maybe fairly close to 7. But
Yeah, sure.
I think if you look at the financials as well over the last 5 years, so revenue, it's up a fair bit. It's maybe up about 10% over the past 5 years. And
Okay, sure.
earnings per share, it's declined slightly, but we're talking about, it was 12.4p a share in 2016, and in 2019 it was down to 11.8p a share. So it is a very slow decline. So I think when it's trading at such a low price to earnings, especially when it did drop under 6, and even now at 9, I think to a certain extent, it feels to me like it's priced for a much larger decline than it's currently getting.
So you think it's a bit more of a value play there?
I think so, yeah. It's not something I'd want to hold for the next 10 or 20 years.
No, you'd be
but it is very cheap and very attractive at the minute, I think.
At the moment, yeah, okay.
Well, what do you think of ITV, actually?
Good question. I'm not so keen on it. I can see from a valuation point of view why it could be attractive, but as a business, I think there are more sort of structural shifts going on, and I suppose how much longer are we going to have? I suppose ITV being digital, but sort of traditionally a terrestrial broadcaster, the shift online, how high quality are the shows that they're producing? And then that's obviously...
So you don't think Love Island is a high quality show?
Okay, I'll admit now that I haven't ever watched Love Island, but that's their most successful show at the moment.
Known for its quality, isn't it?
It's known for its quality, and it's got Coronation Street on, of course.
So another high quality show.
Another high quality show. But how many people are still going to be watching those shows? They've got BritBox, or they've got a share in BritBox, I think. That obviously they'll have a sort of subscription service model there, and then there's, I don't know, does BritBox have advertising on it?
No, I think it's just subscription.
It's ad free, It's with the subscription. But then going forward, and the increasing pressure in terms of the advertising, because advertisers potentially companies more likely to advertise on social media and pay for ads there. I think the sort of dominant position that ITV would have had in the past is possibly being eroded, and I can't see it strengthening going forward. That's maybe me being a bit pessimistic on it, but if I were to invest in it, it probably wouldn't be for the long term, and therefore I might be one that I'd avoid.
So you think it's on the wrong side of history, really?
Yeah, I'd say so.
I tend to agree. I think even with BritBox, I don't see a scenario where the terrestrial channels disappear and BritBox takes its place. I think BritBox is just going to be something where, for people who don't have a TV license, like Americans are interested in British TV, they're maybe going to get a few million subscribers from it, but even then it's not going to cost them much because it's all the historic content. But then that's split with BBC and whoever else is involved, and it's going to add a little bit, but it's not. I don't think it's in the long term going to make up for the long-term decline of the business.
That's where I'm at with it. So like I said, I don't think on a valuation thing it's cheap, but beyond that, I don't think I'd probably be buying it.
I think that's fair. I mean, if the share price was to go back to, for example, 52-week highs, I think I'd be out of it as well.
You'd be out, yeah.
It's not one I'd be holding for 10 years.
No.
Right, so should we move on to Burberry then, John?
Yeah, so Burberry, Sam, what did they come out with this week?
So they've come out with their half-year results to the 26th of September 2020, and they've said that half-year revenue fell 30% to £878 million, and that reflected a 25% reduction in comparable store sales. Operating costs fell less than revenue. This still resulted in a decline in underlying operating profit of 71% to £51 million. So comparable sales in the first quarter fell 45% due to store closures, and the decline was actually only 6% in the second quarter. So that is an improvement from 45 to 6. It's a big improvement.
Right.
So they've said that the second quarter, so the quarter up to 26 September 2020, saw double-digit sales growth in mainland China, Korea, and the US. They've said reduced tourism affected sales significantly, as tourists made up 4% of full price sales compared to 28% in the period last year. And they said that online sales grew by high double digits. They said within the Asia Pacific region, revenue fell 11% to 439 million. In Europe, Middle East and Africa, comparable sales fell 56% and revenue fell 48% to 251 million. They noted that in Europe, Middle East and Africa, tourists typically make up 50% of sales, so that's why the decline's been so significant. And in the Americas, revenue fell 35% to 170 million. They said their wholesale revenue fell 38%, but that's partly due to them reducing their amount of available inventory as part of a plan to reduce excess stock and third-party discounting. And they said licensing revenue fell 24%, which is quite significant, as licensing actually makes up 33% of underlying operating profit. They had a free cash outflow of 45 million, which reflected lower profits and changes to working capital. Net debt was 550 million compared to 538 million at the end of March. And the decision will be made at the end of the financial year, so in 6 months, about whether or not to resume dividends. In terms of the valuation, they're now trading at a PE ratio of 26.8 compared to a 10-year average of 20.1. And this prospective dividend yield is 2%. What are your thoughts on Burberry, John?
So it's not a company I've looked at too much from an investment point of view before, but I do like it overall. I think it's quite a quality business. You can see why it's been hit badly by coronavirus, but you would hope that with sort of, I suppose, the potential of Pfizer and some of the other drug companies coming out with a vaccine, that international travel may return to something that was closer to normal. And that may really lift Burberry with the tourism that so much of the sales come from. And then it may get back to some more semblance of normality going forward in the next 18 months. And yeah, while the earnings are going to be down over this year, if we do get back to that sort of normality, then it could be quite attractive at the current price for Burberry. And it's sort of the high-end fashion, so it's got a lot of pricing power. So I think over the longer term, I'd be quite bullish on Burberry, actually.
Yeah, it's interesting because although they've had that high double-digit sales growth, because so much of the business is a result of tourism, it's not been able to anywhere near offset it.
No, quite. It's still got quite a lot of cash on the balance sheet.
It does, yes. So it's market cap of 6.5 billion. And what was the cash figure?
542 million.
That's 10% of the market cap almost. That is a good amount of cash. I thought it did look like a quality business. It's not one like you that I've really looked at before. It is a quality business, but it's still fashion at the end of the day.
I mean, it is still fashion, but I think at that end of the market, it is, these brands do command huge loyalty. And I think, especially in Southeast Asia, Burberry is a very popular brand. And it's that sort of quintessentially British brand as well, which is valuable in itself.
I was surprised by how global it was.
Yeah. Oh, yeah. No, it's massive. And it did, I mean, probably 10 or 15 years ago, it did have some image problems with, I suppose, fake Burberry and the wrong type of people from Burberry's point of view wearing it. And it had that, it did, the sort of the chav, the British chav image. But I think they've largely moved on from that. And it is regarded as a premium brand.
I mean, in Asia Pacific, the fall was a lot less compared to a 56% fall. A 48% fall in Europe, Middle East and Asia. But if you look at normalized figures, they're probably about the same. So yeah,
which is quite impressive.
It is very impressive, yeah. I liked it more than I expected. It does look like a quality business.
Yeah, no, that's right. And to me, I mean, we can compare the companies at the end, but it would be much more attractive at the moment than ITV, personally, I think. And it would be something, it would be a company that I'd be, if I were to purchase it, that I'd be holding for a number of years, I think.
I wouldn't as well be put off by that price to earnings of 26 compared to the 10-year average of 20.
Exactly.
So in terms of the share price, like I said, market cap of 6.5 billion. Shares are currently trading at £16, 7p a share. Yearly high of £23.40 a share, and yearly low of £10.17 a share. So it's still some way off. It's 50.
It would be a reasonable entry point.
Yeah, I think it would. Business. Yeah, especially if the end's now in sight.
Yes,
it does look like a quality business, and I do.
Yeah.
I don't know if my concern would be it is still fashion, even if it is at the luxury end. But I guess those brands do have a lot more staying power.
Yeah.
So I did like it.
Yeah, no, I agree with you there. So it'll be going on my watch list.
So shall we move on to the house builders next?
Okay, so we had two of the big house builders reporting this week. We had Persimmon, which is, I think, I'll just check this, but I think it's the largest of the house builders by market cap. And it was fairly positive news from Persimmon. So third quarter private sales were higher, 38% than the same period last year. So that's despite having slightly higher cancellations. And they're now fully sold up for 2020 with 1.36 billion of forward sales going into 2021 and beyond, which again is about 43% ahead of last year. And they expect that second half completions to be at least in line with 2019. And they noted that the house prices sort of have remained firm, which is obviously very positive for them. And at the end of October, they had about 960 million in cash on the balance sheet, and they committed to spending about 325 million of this on land purchases. You can compare that later with Taylor Wimpey's approach. They have confirmed a dividend, or an interim dividend, of 70p per share, and they'll update investors on the plans for the capital return alongside the full years in March 21. They've been focusing their attention on some problems that have been in the press over the last few years, which have been largely build quality issues and customer care problems. In terms of challenges for the business, there's certainly social distancing protocols continuing is a problem on the building sites. And then there's also the sort of more structural long-term or macro risk of a prolonged recession, which with house builders being cyclical businesses could really impact on companies like Persimmon. Do you have any thoughts on those results, Sam?
I do. I don't know if it's better to wait until we've done Taylor Wimpey as well, because then we've got more of a comparison.
Yeah, fine.
Because my main thoughts are on the land banks and the different approaches.
Okay, excellent. I'll come on to that. In terms of the land banks, I mean, I suppose let's go back to the last recession, so like 2008. The builders are in a much better position than back then, and they've got much healthier balance sheets in comparison, and they've still got quite a lot of money tied up in land, but like I say, much better than in the previous recession. And I suppose the real risk to them is that they won't be able to sell the houses that they are incomplete on at a profit, and that could lead to some write-downs in the book value of some of their assets. But it's interesting, actually. Persimmon is probably taking a more cautious approach to buying land, which is slightly different to Taylor Wimpey. So I'll move on, and we can sort of come back, compare and contrast Taylor Wimpey to Persimmon. In terms of valuation, its price to earnings is currently about 12, and its prospective yield, assuming the dividend returned, is potentially about 8%. So it's, if it goes ahead, really quite attractive. In terms of Taylor Wimpey, the management announced that full year operating profit for 2020 will be towards the top end of the market expectations of between 242 and 292 million. And it also expects the operating profit to be materially above the top end of analysts' estimates in 2021, which would be above 626 million. Sales rates in the second half have been about 0.76 homes per outlet per week. And that was compared with 0.93 per outlet per week last year. So not a huge drop, not what you might have expected from the house builders and Taylor Wimpey in particular. And then cancellation rates have fallen, and they are a bit higher than last year, but it's 20% compared with 15% the previous year. So not massive impact really. And the order book is healthy, currently 3 billion, an increase from 2.7 billion last year. The difference with Taylor Wimpey is that during the sort of the peak of the first lockdown, Taylor Wimpey went out and were quite aggressive in purchasing land at a discounted price. They did a capital raise to pay for that. And as a shareholder, I was diluted, but I think they purchased in the region of, well, I think the capital raise was about 500 million, and they purchased about 826 million of land in the second half.
Was the capital raise specifically to purchase land, or did they do the capital raise for another purchase, for another reason, and then use it to purchase land subsequently?
My understanding is that it was primarily for the land purchase.
Okay, because that does make a difference to my opinion of it, actually.
Okay, yeah, no, that's my understanding. I think they've done the capital raise. They paid out a huge amount in dividends in the with sort of 7.5+% yield over the last few years, and then they've done a capital raise and diluted you. But anyway, the purpose, as far as I understand it, was for land purchases. So it's sort of quite opportunistic that the prices were depressed, and they went in quite aggressively for that. And now the balance sheet is quite healthy, but at the same time, they did raise capital earlier. I think they've got about 750 million on the balance sheet, and the management, they expect to resume dividends in 2021 with a final dividend retrospectively from 2020. But I mean, we're yet to hear this, and it does depend presumably on how the next 6 months pan out with the current lockdown, and whether we're going to sort of be returning to normality anytime soon. But that's sort of, if you're optimistic, that could be what's on the horizon. And the valuation, not dissimilar to Persimmon, it's 11.3, and the prospective yield is about 5.5%, but that is dependent. So did you have any thoughts between the two and on house building generally, Sam?
In terms of the sector, I do actually quite like it at the minute. I know people talk about it being a cyclical stock that's going to rise and fall with the economy, but in the long term, we do have a quite serious supply problem in the country. So even though there'll be peaks and troughs, I think, if you have a long-term view, I think it's a good place to be. The approaches are obviously very different. So you've got Persimmon being a lot more conservative in that they've not acquired anywhere near as much land as Taylor Wimpey, or certainly as a proportion of their size. Taylor Wimpey have been quite aggressive with it. There is a risk that Taylor Wimpey could be caught with their trousers down. I think, if it works, they're going to look very clever. But if it doesn't work, I think it's possibly quite irresponsible given the environment. If I had to pick between the two, I'd probably prefer the more conservatively run Persimmon at the minute. Persimmon, they have the issue that you mentioned of issues with build quality. I mean, Taylor Wimpey as well on a valuation basis. What was that? PE, 12-month forward PE of 11.3 compared to 12.1. So it was a little bit cheaper. And prospective yields 5.5% compared to 8.1% for Persimmon. I'd probably go with Persimmon, to be honest. What about you?
It's difficult. I suppose I agree with you to some extent, and I would agree with the long-term fundamentals of the UK housing market still being attractive. And I think, like you say, we have a housing shortage, and all of the political parties are committed to further house building. Interest rates are at a record low. So you've got cheap mortgages, and also you've got the cut to stamp duty, which probably also supports the market. So I'd possibly roll the dice and go for Taylor Wimpey. And with those sort of land purchases that they did make, it could sort of reap rewards in the near future. But I wouldn't be opposed to, I've owned both in the past, and I wouldn't be opposed to either, really.
I thought when we looked at Redrow, I thought that looked like the best of the three.
The best of the three,
If I was going to buy one, it would be Redrow.
And I suppose also it depends on whether you want exposure to London or not. So I don't think Persimmon has any house. I think it's all out. It's Yorkshire based, but all outside London. So I guess it depends on what you think of that as well.
So should we move on to Direct Line next?
Yeah, so Direct Line is quite a fairly large insurance group in the UK. So predominantly car insurance. What have they come out with this week?
So they have come out with their trading update for Q3. So Direct Line, as you mentioned, are the insurer, and their brands include Churchill, Green Flag, and Privilege. So they've said that their third quarter written premiums fell 0.8% to 851 million. 617 million of these were own brand policies, which represented an increase of 0.3% on last year. The management have said that they expect the full year combined ratio, which is the percentage of premiums that are paid out in claims and costs, to be below the 93 to 95% target range, which is to be expected because there's less people driving.
Sure.
The group also reiterated its expense ratio target of 20% by 2023. For the third quarter, motor premiums fell 2.3% to 447.2 million. They said there was less demand for more expensive insurance as fewer people were buying new cars and fewer young drivers entered the market. They've said for claims frequency fell, but the average claim severity was higher because COVID meant that the repair costs were higher due to longer repair times and additional cleaning requirements.
Yeah.
Own brand home policies rose 1% to 112.8 million, although they've said their old partnership business declined, and as a result, total home policies fell 1.3% to 156.6 million. Green Flag rescue premiums rose 9.6% to 26.2 million. Other rescue and personal lines fell 9.1% to 85 million, primarily due to lower travel insurance demand, and commercial premiums rose 9.9% to 136.5 million. So it looks like that reflected the strength in their own brand policies for small and medium-sized enterprises, and also the fact that Churchill trades on price comparison websites.
Okay.
The group said
Direct Line as a group, or that's not on the price comparison?
No, I don't think so.
Yeah.
So the group said there's no change in their net estimate of the impact of COVID-19, and they still expect business interruption claims of £10 million and travel claims of £25 million. And they've said the cost of extra customer support relating to coronavirus is probably about £90 million. In terms of the valuation, they're currently trading at a 12-month forward PE ratio of 11.1 compared to average since listing in 2012 of 11.2. So pretty much at historic levels, really. And they have a prospective dividend yield of 8.5%.
Which is very attractive.
It is, yes. I'll just go on to the valuation as well. Yeah, so the market cap's 3.96 billion. Current share price currently at 293p, compared to a yearly high of 350p and a yearly low of 225p. It looks like the impact of coronavirus has been quite limited, just because although they've had higher claims in areas such as travel, there's been reduced motor claims. The dividend was temporarily suspended, but the group are now paying a special dividend to catch up on what was missed.
Yeah.
The main issue for it is that insurance is very competitive and the product's quite generic. There's not really any brand loyalty, although they do have some strong brands. I guess the only impact of that is if you were looking and they were as cheap as someone else, you'd probably go with the one you recognised, but I don't think you'd be willing to pay more for a better brand, or not significantly more. They've said that in the long term, they actually expect motor claims to rise at about 3 to 5% a year, which puts upward pressure on prices as insurers have to raise their premiums to compete.
Do they have any strategy to deal with that?
So the CEO, Penny James, current focus is on cutting costs and leveraging recent investments in technology.
Okay.
But yeah, I mean, there's not really a lot they can do, I don't think.
No. Okay. So what do you think overall then?
I liked it. I thought it was reasonably priced, good dividend yield. The fact that they've been able to not only resume dividends, but actually pay the dividends that were missed is very encouraging. P of 11, you're probably not going to get a huge amount of capital growth, but I thought it looked like a good business.
Yeah,
It's
a good dividend return on it.
Yeah,
dividend yield. Yeah,
it's similar to Burberry, really. I thought, where it looked like a quality business. It is in a tricky industry. I suppose you think it's harder for an insurer than a luxury.
Yeah, I would have thought so. Yeah, I mean, between the two, quite different businesses, but I'd be going with Burberry, and I think the room for growth as well with Burberry as well, the pricing power that it has.
See, I think I'd go for Direct Line out of the two. I quite liked it. It's just like a quality, steady as she goes business, and
yeah,
but
I suppose they are different. They are different investment cases.
Yeah,
and you may want an insurer in your portfolio, but it wouldn't be filled. That's not a place that would then be filled by Burberry. So you could happily own both of the businesses.
But no, it's just a good steady as she goes business, isn't it? Really.
No, I would agree with you there. It's not a business that I dislike.
But I think given that it has been relatively unaffected by coronavirus, the fact that it's not trading at any premium or anything to the historic PE, that is quite good, especially when the dividend yield's so high and so many other companies aren't paying dividends.
Yeah, that's right. And I mean, we saw that we talked about the supermarkets the other week, but they're coming under quite a lot of political pressure after the business rates relief to not pay out their dividends, which have been quite sizable from Sainsbury's and Tesco's.
Should we move on to our final business then?
Yeah, so final business is Disney. So I'm sure that doesn't need much explanation for anybody, but it was mixed from Disney, I think. It was probably, I don't know whether you describe it as positive. It wasn't as bad as some analysts had been expecting. So full year revenues came in at $65.4 billion, which was down 6% year on year. Yeah, like I say, better than most analysts were expecting, given that it had been quite gloomy with coronavirus. They'd had vastly reduced capacity in the parks, and that had led to a $1.1 billion loss in the final quarter on those. And then they'd had sort of restructuring costs, which had been associated with the mega deal that had been buying 21st Century Fox. And that was a deal which was worth $71 billion. And there'd be the sort of costs associated with setting up, or I say cost, investment in Disney Plus, and also cancelled sports events, which one of the businesses that Disney owned, ESPN, had been hit by. In terms of the positives, the rapid growth in the direct-to-consumer part of the business, which was Disney Plus largely. They've got Hulu as well. Disney Plus getting 74 million subscribers. The direct-to-consumer revenues up 81% year on year, despite them still being loss-making. And overall, the business's operating profits fell by 45% to $8.1 billion, which again, better than analysts had previously expected. And the decline was largely down to the parks business, falling from a $6.8 billion profit in 2019 to $81 million loss this year. What do you think, first of all?
I thought they were actually very good results, given the circumstances. I thought, when you look at the businesses they're in, it's like if you wanted to make a basket of industries that have been worst affected by coronavirus, they're in most of those. So they've obviously got the production studios, which will have been hit by the shutdown of cinemas. They've got the cruise ships, which speak for themselves. They've got the parks, which no one can go to. It's a lot of different businesses that are not good businesses to be in at the minute. So for full year revenue, given what's been included in that year, to only be down 6%, and operating profit only to be down 45%, I think it is a testament to the quality of the business.
Yeah, I mean, I couldn't really agree with you more on that. I think it's such a quality business, and if you're optimistic about what's going to happen in the next few years with coronavirus, then I think Disney has a very positive outlook. It's got huge brand loyalty, and it feels like it's future-proofed as well, with the direct-to-consumer side of the business as well, which I appreciate at the moment is still loss-making. But I think going forward, they should be able to turn that into a profitable part of their portfolio.
Yeah, I mean, Disney Plus, I'm particularly bullish on. I think over 70 million subscribers, and it only launched in March. That is just unbelievable. Yeah. I don't want to go into it in too much detail because we actually talked about Disney in relation to their restructuring a few weeks ago. And I did talk about my thesis of why Disney Plus is such a big thing for that business and why I don't think it's priced in properly at all at the minute. So you can just go back and listen to that. I won't bore the listeners who've actually already heard it. But even I think with the direct-to-consumer business being at a loss, like I don't think much of that will be Disney Plus, because a lot of Disney Plus, they've just put stuff on there. It's probably more to do with like Hulu and ESPN, I'd have thought.
Yeah, no, that is true. I think ESPN particularly, and I suppose some of those sports events we don't watch so much over here in the UK, but in the US, it's a big thing. Not dissimilar to, I suppose, ITV having their Euros, the Euro football competitions cancelled.
Yeah, and as well, given the year they've had, 3.6 billion of free cash flow, which obviously a lot of it's due to lower taxes and cutbacks on capital expenditure. But as well, net debt of 40.7 billion was actually down from 41.6 billion a year ago.
Yeah, so that's right.
They've really been able to weather the storm without making the business any worse.
No, that's right. And like we say, depending on how you view the next sort of few years or the next sort of year, particularly with coronavirus, it could be very positive, especially from the parks point of view.
Yeah, so in terms of the media networks was up 14% to 28.4 billion. Parks, experiences, products down 37%, 16.5 billion. Studios down 13% to 9.6 billion. And direct consumer, I think you touched on that one already, up 81% to 17 billion. That's a very diversified business. And I think what makes it so exciting is that direct to consumer is probably going to be very high margin once it's finished growing.
Yeah. That's right.
I mean,
the content production that they can put on there as well. Netflix and Amazon, I suppose, they had to start with their own studios and building it, and same with Apple. But this is a business that Disney are very familiar with.
I think for a $250 billion business to have such an exciting future ahead of it in the next few years, I think it's quite remarkable, really. I think it's just such a quality business.
Yeah. Do you own shares in Disney, Sam?
I don't, and I'm finding fewer and fewer reasons not to own shares.
Okay.
I suspect the next time we talk about this, I may own shares.
Yeah, that's fair enough. No, I do have some, and yeah, I'm optimistic going forward as well. So in terms of the valuation of Disney, its PE ratio it's currently trading at 50. Compared with a 10-year average of 18.4. But obviously that's been impacted a lot by the coronavirus and would likely be corrected going forward, assuming parks and everything sort of gets back to some form of normality. But yeah, I think still, despite that, it's attractive at the moment at the current prices.
Yeah, I'd agree. Especially with Disney Plus.
Especially with Disney Plus. Yeah.
But no. Very, very good business. So I don't know, this could be a tricky one for you, but of the 6 companies we've talked about today, so ITV, Burberry, Direct Line, Persimmon, Taylor Wimpey, and Disney, if you had to have one, which one would it be?
Difficult. Difficult. I'd probably go for Disney. But that's not to say that I don't like either of the house builders we discussed. And I think Burberry was the standout for me that I hadn't really looked at before.
Yeah, I'd agree. Slightly different thoughts on the other businesses, but I like the house builders generally. I did like Burberry and Direct Line. ITV I obviously own, but I think that's more of a value play at the minute. But I think although there were some quality businesses that we've talked about this week, I think Disney is just in a league of its own.
True.
Or certainly compared to those ones, I think it's very difficult to make an argument for picking any other than Disney, really.
Yeah.
maybe if you were solely concerned with the dividend yield, you'd go with one of the others. I think that's the only scenario I can see.
No, good.
Okay, so shall we move on to just some general commentary about the markets this week then?
Yeah, so I mean, Monday, where do you begin?
That was the day the Pfizer announcement came out.
That's right. So I think some of the phase 3 and the vaccine that they've been working on, the coronavirus vaccine they've been working on, was sort of efficacious, maybe like 90% or something. So it was very good news, and you saw the markets globally really buoyed. And I think particularly over here in the UK, where we'd had certain sectors that had been so badly hit by coronavirus, and the fact that we don't have as much in the way of technology, which arguably has been a winner out of coronavirus, we saw some big moves, particularly oil, banking, anything that was quite domestic and sort of, I suppose, old world industry almost, had really did well. So some of the domestic banks like Lloyd's, that was up sort of 20, or I think it may have been up close to 20%. Some of the similar picture with some of the oil super majors. I mean, what were your thoughts on Monday's events?
It's obviously encouraging, but I mean, the vaccine, it's still going to take months and months to distribute it. I suppose it's more the fact that the end is in sight. Really, rather than anything else.
That's right. I think also it's sort of may bode well for some of the other vaccines that are in the pipeline, if they're all or they've got sort of a similar mechanism, I suppose, for want of a better way of describing it. And if they're working on the spike protein, it's sort of almost like a proof of concept, which could spill over into the others that are coming through. So if this is the major breakthrough, and it means that life can return to something close to normal that we've been used to for the last 6 months, that would certainly be very positive and could be a game changer for a lot of the businesses whose fortunes have really suffered as a result of coronavirus and of lockdowns.
I think there were a lot of businesses, particularly in the FTSE as well, where they were almost priced as if it was the end of the world.
Yeah, that's true. That is true.
I think if it's an airline or something, then it is very justified, the price being so depressed. But there's other ones where it just seemed very clear that a lot of businesses were going to bounce back, and it was just a case of, is it going to bounce back in a year or 2 years? But for a lot of them, they probably just shouldn't have been that low, really.
Well, no, but it does take a brave investor to go in and sort of start buying up UK stock after March, I suppose. That's.
So would you be a buyer of airlines after the new announcement?
I don't think so, but that's probably more just, I'd never be a buyer of airlines, I don't think.
BA was up like 40%, wasn't it?
Yeah. But I mean, would you?
No,
sorry.
Well, I wouldn't touch it.
Yeah, it's exactly. I still wouldn't. Well, it still wouldn't really interest me.
I didn't want it before the global pandemic.
No,
I certainly don't want it now.
No, that's right. So if you're a trader, maybe this is the sort of thing that you'd be sort of interested in. But no, I mean, it's certainly been a winner from the news. But I'm not keen on airlines as an industry to invest in. But I would like to go on my holidays again. So
did your portfolio benefit, or?
So mine did. So in terms of individual stocks, I've got a number of UK listed stocks, and a lot of them, particularly the banks, for example, did benefit a lot. Some of the house builders as well, and energy. So yeah, I overall did benefit from the news on Monday. But that said, we had a couple of stocks, one in particular that had been one of the winners of lockdown, Reckitt, that we discussed a couple of episodes ago. That was down about 6.5% on the day. So that was one of the losers. presumably expecting fewer sales in terms of Dettol.
Yeah. So
But-
my portfolio was maybe down slightly or flat because all my
Okay.
So I had some big UK winners. So I had like ITV.
Yeah.
I can't even remember what. I'd have to look at my portfolio now. I had quite a few stocks that did quite well out of it. But then on the flip side, I have quite a few of my larger positions, what you'd call like the US stay-at-home tech stocks.
Yeah.
So they were all down on the announcement. So it just offset.
And I
it,
suppose,
really.
it didn't coincide with, but it's sort of been around the same time or similar time as the US presidential election. So that, I suppose, comes into it a little bit as well. But no, I suppose overall it was a very good week for the markets.
Yeah, I think so.
But we'll have to wait and see because it's very early days.
So is there anything else you want to discuss?
I don't think so. I think we've covered most of the news this week. So yeah, did you have anything, Sam?
I did read Hot Commodities. I think I mentioned
Oh,
that I'd ordered
okay.
it. So I didn't want to do a full review on it just because I didn't think it was that great.
Oh, I see. Okay.
It was an interesting book.
Yeah.
But the book's about 15 years old. So a lot of the stuff he was talking about it hadn't aged particularly well. And then it was interesting to see because he went through different commodities in like the second half of the book. And he was talking about reasons why he thought they were going to do well or not. And it was very clear to see what he looked at in terms of things that were affecting supply and things that were affecting demand. And I think if you wanted to, you could read that book and then have a go at actually like investing in individual commodities and possibly do quite well because it makes it clear the research you need to do and things you need to look at. But I just wouldn't. It's quite a lot of effort, and I just wouldn't be doing that. I think because I went into it with the view that I do like commodities as a sector. I think they do deserve a place in certainly a larger portfolio at least.
Yeah.
I think my view was already that if I was going to get exposure to commodities, it'd be through an index fund.
Sure.
I think if you go in with that, you already know enough that you've already sort of feel like that's what you'd want. You probably don't need to read the book. I think.
Yeah.
I don't know if it was interesting, but I don't think I really gained that much from it.
No.
I'd still be doing the exact same thing as before I read the book, but it's still interesting.
And you probably feel you know a bit more about commodities generally.
I think so, yeah. I think, if you wanted to, I think you'd know the things to look at in terms of like looking at individual commodities, and you'd probably be able to have a good go at actually investing in them. And if you were a long-term holder, you'd be able to do quite well in the same way as you could with stocks when you do the proper research and you know what you're looking for. But
yeah,
it's not something I'd ever be interested in putting the time into doing, just because if I wanted that exposure, I'd do it through an index fund.
Which there are plenty.
Exactly, yeah.
Yeah.
So,
great. Okay. Well, on that note, we'll probably leave it there. Thanks for listening.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.